If you have spent any time looking into personal finance online, you've probably heard the exact same advice repeated like a broken mantra. Just buy an S&P 500 index fund, turn off your brain and wait 30 years. And for a long time, that advice felt completely unbeatable. Over the last decade, the S&P 500 returned an exceptional annualized return of more than 12%, making anyone who concentrated entirely on U.S. large-cap tech look like a financial genius. But the investment landscape has shifted underneath our feet, and blindly following that old playbook is getting incredibly risky. Today, we're going to break down an advanced, highly resilient portfolio architecture designed to fix the hidden flaws of standard index investing. This strategy allocates 20% to a global ETF, 20% to an emerging markets ETF, 20% to a small cap ETF, 20% to a global ETF excluding the USA, 10% to a high-conviction individual stock, and 10% to precious metals via an ETC. This isn't just a random collection of assets. It is a carefully calibrated ecosystem built on hard economic data, historical premiums, and strategic asset protection. Let's dive into exactly why this specific composition works and how the numbers back it up. The anchor 20% global ETF, FTSE All World. We start building this portfolio with our foundational anchor, a 20% allocation to a global ETF, specifically tracking an index like the FTSE All World. This is our baseline safety net. This single fund gives you instant exposure to thousands of large and mid-cap companies across both developed and emerging economies. It ensures that you always own a piece of the world's most dominant corporations. However, the reason we only allocate 20% here, instead of putting all our money into it, comes down to a massive structural issue that most everyday investors completely overlook: geographic concentration. The anti-concentration shield, 20% MSCI World ex-USA and 20% FTSE emerging markets. To counter the extreme weight of the US market, we introduce a powerful counterweight, 20% in an MSCI World ex-USA ETF and 20% in a FTSE emerging markets ETF. Combined, this 40% block forms our anti-concentration shield, and the data shows exactly why this is vital right now. Consider the sheer concentration risk inside the U.S. stock market. The top 10 companies in the S&P 500 now command an astonishing 38% of the total index value. When you buy a U.S.-heavy fund, you aren't buying a broad basket of American commerce. You are buying a hyper-concentrated bet on a handful of mega-cap Silicon Valley tech giants. Compare that to the MSCI All-Country World ex-US Index, where the top 10 companies make up only about 11% of the total. By allocating 20% to developed markets outside the US, countries like Japan, the UK, France, and Germany, we are buying into world-class companies at drastically cheaper valuations. Historically, the cyclically adjusted price-to-earnings, or CAPE ratio, for U.S. equities has hovered at highly elevated levels compared to Europe and Japan. Valuations matter eventually, and buying assets when they are fundamentally cheaper implies higher expected returns over the next decade. We pair that developed international exposure with 20% in emerging markets. Countries like India, Brazil, and Taiwan represent the real boots-on-the-ground GDP growth engines of the coming decades. While the U.S. market has enjoyed an incredible run, international cycles rotate. We saw this clearly when non-US developed markets posted massive gains of nearly 32%, and emerging markets skyrocketed by over 33%, comfortably outpacing the S&P 500's return of around 17%. By holding this 40% international block, you position yourself to capture massive global growth waves without relying entirely on a single domestic market. The engine room, 20% MSCI World Small Cap. Next, we allocate 20% to the MSCI World Small Cap ETF. If large cap global ETFs give you stability, small caps give you raw economic horsepower. Most retail investors ignore small cap companies because they are infatuated with trillion-dollar tech behemoths. But financial science tells a very different story. Decades of empirical economic research, most notably the Nobel Prize-winning Fama-French three-factor model, demonstrates the existence of the size premium. Over long horizons, small-cap stocks have historically outperformed large-cap stocks. The math behind this premium is incredibly logical. It is mathematically very difficult for a $3 trillion company to double or triple its revenue. The amount of global market share it needs to capture to make that leap is astronomical. But for a highly innovative, agile $1.5 billion small-cap company, doubling, tripling, or even 10x in its revenue is entirely possible. By dedicating 20% of your capital to global small caps, you ensure you own the innovators and the disruptive market leaders of tomorrow while they are still small, catching their most explosive growth phases before they ever graduate into the major indexes. The high conviction alpha slot, 10% individual stock, Take-Two Interactive. Now, let's address the 10% allocation to a single stock you deeply believe in. Pure index investing is incredibly smart, but it can also feel sterile. It leaves no room for you to act on your own specialized knowledge, industry insights, or deep fundamental research. That is why we carve out exactly 10% for a high-conviction satellite play. The strict rule here is that this slot must be reserved for a company where you see an undeniable, asymmetric upside catalyst that the broader market might be mispricing. Let's use Take-Two Interactive, ticker TTWO, as a perfect case study. Right now, Take-Two is trading around the $255 to $257 mark, and the fundamental thesis for this company is anchored by what will likely be the largest entertainment launch in human history. Rockstar Games, a subsidiary of Take-Two, officially opened pre-orders for Grand Theft Auto 6 on June 25, 2026, with the global release locked in for November 19, 2026. When you look at a catalyst like this through a corporate finance lens, the revenue runway is staggering. The predecessor, GTA 5, generated over $1 billion in its first 3 days and went on to become the most profitable entertainment product ever created, sustaining a highly lucrative microtransaction ecosystem for over a decade. GTA 6 is positioned to completely reset the baseline for Take-Two's cash flows, driving massive digital pre-orders, premium edition sales, and long-term recurring revenue through its next-generation online architecture. By limiting this high-conviction play to exactly 10% of your portfolio, you create a beautiful mathematical balance. If your thesis is correct, a 10% position is large enough to inject a substantial amount of alpha and explosive growth into your total net worth. But if unexpected headwinds occur, your remaining 90% is broadly diversified across global markets, ensuring your financial foundation remains completely safe. Chaos Insurance, 10% ETC, gold and silver. The final piece of our puzzle is a 10% allocation to an exchange-traded commodity, ETC, split between gold and silver. This is your portfolio's airbag. Equities are spectacular tools for building wealth, but they are intrinsically tied to economic growth, corporate earnings, and systemic stability. When geopolitical tensions flare, when inflation spikes unexpectedly, or when central banks print currency at unprecedented rates, paper assets can experience violent drawdowns. Gold and silver carry absolutely zero counterparty risk. They cannot be printed into oblivion by a central bank, and they have functioned as ultimate stores of tangible value for over 5,000 years. More importantly, precious metals have a historically low correlation to the stock market. When panic strikes and global stock indexes enter a correction, Capital instinctively flees risk assets and floods into safe havens like gold and silver. This inverse relationship means that during market crashes, your 10% commodity allocation will often spike in value, cushioning your total portfolio drawdown. It is the tactical insurance policy that keeps you emotionally grounded, preventing you from panic selling your stocks during temporary market downturns. Conclusion: the power of rebalancing. When you step back and look at this entire portfolio composition, you see a masterclass in structural diversification. 80% globally diversified equities, aggressively tilted away from over-concentrated U.S. megacaps, 10% high-conviction alpha, and 10% hard asset chaos insurance. But the real magic of this portfolio isn't just the initial allocation. It is what happens when you rebalance it. Because these asset classes move in different cycles, they will naturally drift. When international markets outperform like they did recently, or when individual stocks like Take-Two surge around massive product launches, that specific slice of your portfolio will grow beyond its designated percentage. Rebalancing forces you to systematically sell a small portion of your winners when they are riding high, and reallocate those profits into the areas that are temporarily underperforming and undervalued. It strips emotion out of your investing entirely, mathematically forcing you to execute the golden rule of finance: buy low and sell high. Build the foundation, trust the diversification data, rebalance systematically, and let global compounding do the heavy lifting.